This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Patronic, June 2008, question 1F7. It's question 50 in Kaplan revision kit. Patronic, let's see what it's about. Part A, calculate goodwill arising on the acquisition of a company. Prepare consolidated income statement. Assume that the investment in Acerbic has been accounted for using equity since its acquisition. And part C for floor marks. Not much for floor marks. At 31st of March, the other equity shares, 70% in Acerbic, were owned by many separate investors. We are doing March 09 and top of the previous page, page 66 in the kit. It says we have held an investment of 30% in the equity shares in Acerbic for many years. And at the start of the year, the other shares in Acerbic were owned by many separate investors. Shortly after this date, speculate, a company unrelated to Patronic accumulated 60 of the remaining 70% by buying shares from the other shareholders. In May 2008, so 2 months after the start of this year, a meeting of the board of directors of Acerbic was held, at which Patronic lost its seat on Acerbic's board. Explain with reasons why the accounting treatment should... it's not this year. At the end of this year, it's saying we're preparing income statement to March 08, and how should we prepare financial statements for the year March 09. Okay, it's 4 marks. It's 4 points, 4 things I have to say. Divide by 2 is 2 minutes. So I've got 2 minutes of planning time, and 4 marks is... 4 times 2 is 8, take off 10%, 7.2 minutes to actually answer the question. I've also got some, not a lot, but I've got some reading time at the start of the exam. What I'm going to do is I'm going to plan 4 things to say. I don't want to have to write them out in the time available. I'm going to plan my answer. At 31st March, so at the end of this year, the other equity shares in A were owned by many separate investors. Shortly after this date, a company comes along, buys a 60% stake, so it acquires Acerbic as a subsidiary by buying from the other shareholders. In May, at a meeting of the board of directors, we lost our seat on the board. Explain with reasons the accounting treatment that we should adopt for investment in Acerbic when we prepare financial statements for the year end. Okay. Shortly after this date, an associate is one where we have a significant influence. That's taken to be 20% or more, but it's not conclusive. The other indications are representation on the board, and participation, the power to participate in policy decisions, and particularly their dividend policy. I want to use the word rebuttable, because we still do have greater than 20%, but of course somebody else has got 60%. So speculate now has control, they have a subsidiary, and we therefore have no say. It's not technically correct. We do have 30%, but and therefore we can stop special resolutions from being passed. But it's called negative control. We can't actually dictate any policies, and if we want a dividend and they speculate say no, then no dividend will be paid. Not only that, but we don't even have representation on the board. We have no say. We have no director. And in fact, the IFRS, this is unfair for this particular question. This question was a June 2008 question. Is that right? June 2008 question. And IFRS 10 has now been issued, and it spells out more clearly control and when is a company a subsidiary, because we can maybe control it even though we don't have more than 50% of the votes. And in this particular case, the acerbic situation, I'm suggesting to you that under IFRS 10, let me get this right, under IFRS 10, 30% with loads of tiny other shareholders is effective control. And therefore we should have been, well, with effect from IFRS 10, we should have been or should be consolidating. But that's with effect from IFRS 10, and it's way before June 2008 exam. Question says, explain with reason the accounting treatment. Equity account up to date of losing significant influence. Fair value at that date, and stop equity accounting. Account only for dividend stream. Because we have no influence, we certainly don't have control, never did have, until IFRS 10 came along, but we didn't have control according to the established traditional principles, but even now we've lost even our significant influence. So that would do it for my 4 marks. There's a hell of a lot there for 4 marks, but that's to tell you. 7.2 should get me to 13.16. In fact, it has done. So there's my 7 minutes added on. That gets me to 13.16. And it means then that I've got, what is it, 21, 42, 38, 37.8. 37.8 minutes to get me to 7.2 to go to 13.54 is my finish time. Alright, 13.54 finish time. Let's look at this then. Goodwill arising for 6 marks and then comprehensive income statement. Okay, on the 1st of August 2007, we're going to March 8, working 1, Patronic. We've got acerbic over here. We bought 18 million shares. Out of 24 million, 75%, 25%, and I know that we have 30% of acerbic. On 1st of August 07, we're going to March. So I'm going to do this on my fingers. I'll do it on here as well, but I would do it on my fingers. So August, September, October, November, December, January, February, March. That's 1, 2, 3, 4, 5, 6, 7. That's 8 months. 8 months post, isn't it? So it's 4 months pre and 8 months post. It's very easy to say August is the 8th month, and we bought in August, therefore there are 4 months after that up to the end of the year, and that clearly would be wrong because we bought on the 1st of August. One of the things I do with the P2 students is I ask them how many months are there between April and August, and the answer is, well, it's obviously April, May, June, July. It's actually anyway, it could be 3 months, it could be 4 months, it could be 5 months. between April and August, the 1st of April through to the 31st of August is April, May, June, July, August. Or the 1st of April through to the 1st of August is April, May, June, July. Or if it were the 30th of April through to the 1st of August, then it's just May, June, July. So it could be 3, 4 or 5 months. And it's one of the things that you should get into the habit of doing, particularly with something like earnings per share questions, where there will be monthly splits. And F6 exam, your taxes, there's typically a split in the tax year, and just get used to doing it and using your fingers and counting the months. It's silly to throw away marks just because you can't count your months. So it's 4 months pre, that's April, May, June, July, and we bought on the 1st of August, and 8 months post. And this is for a full year, the associate company. So working 2, we can get into that. Now the goodwill calculation, cost of investment, 18 million. The share for share again, 2 for 3. So we bought 18 million. For every 3, we're going to give 2. The value of our shares is 575. So that's 12 times 575, and that's 69 million. We'll also pay cash on the 31st of July, that's 2 years later, per share. So we're buying 18 million shares, we're paying 242 cash, and we're doing it in 2 years' time with a cost of capital at 10%. 1/1 plus the cost of capital, 1/1 plus the cost of capital. And that's the way it is. That's how to discount it for 2 years. I'm going to reduce that down to, because it looks nicer, probably more professional, but that's what the way we're looking at. So 18 times 2.42 divided by 1.1 divided by 1.1 equals 36. And that's the cost of the investment. That's 105. Then we've also got the NCI. Down towards the end of the question, ignore deferred tax, good. All items accrue evenly, good. So of the 6 points, that's 2 of them dealt with. Point number 4, we've got the policy value NCI using fair value at date of acquisition 30.5. So the NCI is 30.5, 135.5 therefore the value of the company. And impairment tells me that it's got to be written down by 2 million. The goodwill is going to come down by 2 million. The value of a Serbic is not impaired. Okay, fair value of net assets at date of acquisition. The reserves, we've got the shares. First of all, shares is 24 million, and we know that they're $1 shares because it tells me on line 3. Retained earnings 69, and then there's going to be, I know now, there will be a fair value adjustment. There we are, paragraph 1. The fair values of net assets were equal to the carrying amounts with the exception of property and plant. So we've got property, which is 4.1 million higher. We've got PPE, which is 2.4 million higher. The increase in the fair value is going to create additional depreciation. So I've got 200 depreciation. I'm going to put this in my question paper. Sardonic cost of sales plus 200 for the depreciation. I'll tell you what I will do as well, because I often forget it. I'm going to unroll this. This has been going for a year, so plus 3.6 finance cost, plus 3.6 finance cost is now in my question paper, because this is 1 year closer to this. This took place on the 1st of August 07, and we're now doing, it's not 3.6. We are now doing the accounts to 31st March, so it's 8 months. It's not a full year. So it's 3.6 for a full year, and therefore it's 2/3 of that, 2.4. So back again to the question paper, 2.4. for a part year. 2.4 unrolled. Okay. So I'm back again on this depreciation. In post-acquisition, the plant had a remaining life of 4 years. Plant, 4 years. PPE, 4 years, that's 600 per annum. But we're only doing 8 months, so that's 400. So plus 400 depreciation there. And again, that's going to go into my question paper. Plus 400 depreciation. Okay. All depreciation cost of sales, that's where I've put it. Fair values have not been reflected in Consolidated statements. No adjustments. Finance costs do not include the finance cost on the deferred consideration, which is just reminded me therefore about this 2.4 unrolled, which I've now included. Prior to acquisition, we've been a good customer. I'm in therefore to paragraph 3. How can I be in paragraph 3? Have I dealt with the fair values? Fair value, fair value. Retained earnings brought forward. That's retained earnings brought forward. I've got retained earnings for 4 months. Retained earnings for 4 months. Retained earnings brought forward, it tells me, was 69,000 at the bottom of the opening introductory paragraph. Then I've got the profit for the period, and it's 1/3 of that, which is 4.5. Acerbic's been owned for a full year. I think that should be the assets at date of acquisition. So that's 10, 70, 80, 104. Gives me 31.5 goodwill, and am I going to impair it? Yeah, by 2 million. Impair by 2 gives me 29.5. And it doesn't tell me where I'm going to put my 2 goodwill, so I'm going to 2 goodwill impaired. I'm writing into my question paper, and the allocation of that is 3/4 me and 0.5 for the NCI. And 29.5 is then the... oh, that actually does it, doesn't it? That's the answer there. That's the answer to part A. That's 6 marks. Crikey. That was all right, wasn't it? That was all right. So I'm back in paragraph 3, I'm sorry. Paragraph 3, prior to acquisition, Sardonic had been a good customer. Patronic in the year to March. Patronic sold goods at selling price of $125 a month, both before and after acquisition. So post-ac, we've got 8 months at 125, which is 10 million intra-group sale. And I'm going to write that immediately up here. Revenue minus 10, cost of sales minus 10. That cancels that. Made a profit of 20% on cost of sales. 100 plus 20% markup. Cost plus profit is selling price. So we made 20% markup on the cost. Selling price is therefore 120. I'm doing this for a PUP calculation, because at the end of the year, Sardonic has still got 3 million, and we're looking at 120th as the profit element, times 3 million is 500,000, and that's in P. It's a PUP in Patronic. And again, I'm going back up here, and I'm going to add that to cost of sales. And that will eliminate the PUP. I've done paragraph 4, I've done paragraph 5, I've done paragraph 6, that's it. Good Lord, is that it? Okay. Working 3 we don't need, because the consolidated income statement replaces working 3. We actually do need working 4B, which is the NCI on the income statement. That's 25%. And we also need working 5B, which is the interest in the associates' profits. And we're 30% interest in the associate profits. We can do that one straight away because there've been no adjustments, have there? So it's 30% of 6,000 profit after tax, which is 1,800. And that's the figure which is going to go on the income statement. And yeah, I think I will. I'm just going to write that in. Interest in associate 1.8. I'm putting that in the question paper again because it's easily forgotten. The NCI, their share of the subsidiary, don't forget we're only going to consolidate 8/12, so we're only consolidating half of it, so 8/12 times 13,500 is 9,000. Okay, and we've got adjustments to make. We've got additional depreciation of 200, haven't we? Yeah, we've got the additional depreciation of 200 to come out of that 9,000, and we've got the additional depreciation of 400 to come out of that 9,000. So that's that. What else have we got? We've got the impairment of Goodwill. The impairment of Goodwill is 0.5. Yeah. And it's 25% of that. Okay. Just looking. All right, let's fasten it together and see where we're up to. Revenue is 150 plus 2/3 of 78. 2/3 of 78 is 52. Minus 10 is 192. Cost of sales is 94 plus 2/3 of 51 is 34. Minus the 10, and then we've got the plus the 200 plus the 400 plus the 500 Goodwill. So 128, 118, 119.1, I think. 2072.9. Okay, DC distribution costs. What was the 500? What was that 500 that I just dealt with? Because I've got my Goodwill separately shown. Oh, it was because I'm not writing these things. Probably it's 500 PUP. That's okay. And that's therefore not there. DC is 7,004 plus 2/3 of 3, which is 2. That's 9.4. I've got the Goodwill impairment, that was 2. I'm happy with that, aren't I? Yeah. Admin expenses is 12.5 and 2/3 of 6, which is 4, that's 16.5. I've got some finance costs of 2 plus 2.4. Yeah, 4.4. I've also got that have I got that? 3.6, no, that's done that one. 2.4. I've got share of the associate. Share of associate is 30% of 6. I've already done that. It's in working 5B. That's 1.8. Okay. Don't think I've got anything else. Just looking in the question, making sure I've not forgotten anything. No, I don't think I've forgotten anything. 9, 10, 11, 27.9, 31, 32.3. 32.3 is 50.6, 51, 52.4, I think. I think it's 52.4. Just let me check. I'm just checking because I'm not wildly confident about this for some reason. Okay, well, we'll carry on, and we'll see how we go on, basically. So 52.4 tax. Tax is 10.4 and 2/3 of 3.6, which is 2.4. That's 12.8. 39.6. And I can say, can't I, that of this amount, so much is attributable. 16, 25, 26, 27, 31. That's 42.4, not 52.4. 29.6. Of this amount, so much is attributable to the members of the to the NCI. Yeah. Oh, do you know what you've forgotten? You've forgotten the finance cost. Sardonic's got to 900, so 2/3 of 900 plus 600, that should be 5. Oh dear. That's then for 41.8. 12.8 leaves me with 29 of this amount. Now then, of this amount, how much? It's 25%. It's this figure up here. It's 25% of 812, so 25%. I'll put that in. Of 9,000, 25% of 9,000 is 2,250. 2,250 minus the 200 minus the 400 is 1,650. So of this amount, 1,650 relates to the members of the parent company. 9,000, 25% of 9,000 is 2,250. Yeah. Minus the goodwill, their share of the goodwill, 0.5. Oh dear, I'm going round and round and round in circles. Of this amount, how much relates to the members of the subsidiary company? Depreciation, the share of the impairment. Oh, I can't charge them with that. 9,000 minus the 200 minus the 400 minus the goodwill impairment in full, 2006 gives me 6,004, and their share of 6,004 is 1,600. Of this amount, 1,600 relates to the NCI, and what is it, 27,400 relates to members of whatever the company's called, Pedantic, Sardonic, Patronic. Okay. Well, I must admit my mind wandered then. Quite happy with that. My mind wandered. I'm very sorry. I lost my concentration and I was getting mixed up with these. I dismissed it as being too easy, and I should have done that properly first time through. But otherwise, no, I'm relatively content with that. And that was just stupid, missing off the 900 sardonic finance costs, time apportioned down to 600. That was just a stupid mistake. Okay, 13:39. I said I was got to finish at 13:54. I'm still 15 minutes there. I've done the whole thing in 30 minutes. Practice it, guys, girls. Just practice.